Let's talk about the market, because the market was in the dumps a couple of weeks ago. We're now in a 4-week winning streak, 50% retracement back off our lows from where we were. Still down in the year, not minimizing it. But how do you see things shaking out the rest of the year?
Yeah, the market is banking on the Fed's terminal rate being a lot lower than what it had previously anticipated, Brian, a couple months ago. There's also a fear of missing out, is my sense, in terms of retail investors plowing into the market again, expecting that the Fed put still exists. So if the markets crash, if we go into recession, the Fed is not going to hike as aggressively as everyone thought, but maybe even cut. And maybe they're just joking with regards to the quantitative tightening, which, by the way, Brian, of course, is set to go to $95 billion in the month of September. So I'm cautious. I think that the labor market is set to roll over. We see productivity losses combined with rising labor costs. That's a recipe for job cuts, not additional job gains. So I think 2023 is going to be a rough road, and I'm advising our clients to remain invested, but be hedged, protect your portfolios, even look at some structured products which can cap your downside in a volatile 2023.
Okay, I was going to ask you remain invested where, but you just said structured products. What exactly do you mean by that? Structured products?
Yeah, you can find products that will help you cap your downside, but it also limits your upside in terms of where you're situated, what your positioning is. These are items that in our firm we structure as per the needs of the client. So it's not one defined product. It's something that we look at for each specific client. But also, Brian, we're looking at defensive positions. So energy, and I heard you talk about industrials, utilities, staples. I prefer to take this opportunity to rotate if we're not already in more defensive positioned sectors, which tend to outperform in recessionary environments, to do so at this point. So rotate out of the ones that have moved higher, cyclicals, more high flying stocks, which are supported by the narrative that the Fed is going to not just not hike as aggressively, but perhaps even cut.
We're showing utilities on our screen there, Kathryn. In part, you look at the Inflation Reduction Act. A lot of that money is in tax credits that may end up falling to utilities for upgrading their grids to meet all the power demand that is coming. Are you a believer? You said energy. Are you a believer in utilities?
Look, I'm a believer in the sense that when you have a recessionary environment, which I think is what we're potentially in for 2023, we want to be more conservatively positioned. Yes, the Inflation Reduction Act is really more of a focus on climate change and really healthcare. But I do think that the point here is, where are we in the economic cycle, Brian? And my conclusion is that not only are we on the downside, but I think we're in to see a more difficult environment in the next year when we get consumption dropping, because people are starting to lose their jobs, or they're afraid of losing their jobs. You can't really continue in an environment with record high vacancies, record low unemployment, dropping productivity, where companies are getting less output per hour worked, while labor costs continue to rise. So I think what really turns this market is a rollover in the labor market. I'm laser focused on real wages. They're, of course, very negative. And that, I think, is what is going to affect not just consumption and the real economy, but, of course, earnings going into next year.